that comes from trying to use, and you've got to train yourself not to use, don't use TA to predict prices. Use TA to forecast risk. So say you get your bull flag, right? And you have your support here on the consolidation, you have your resistance here, and you buy a call at resistance hoping the bullish consolidation breaks up, right? But you set your stop on your call at the bottom support, right? And this is what TA is best for. Because the bull flag doesn't tell you how much it's going to break out or how far it's going to break out. It tells you a little bit about where buyers and sellers are, but mostly it tells you where your risk is, right? And so by setting your stop at the bottom support, if this were to fail, it defines your risk for you, right? You get stopped out. If it breaks up, you make money. That's it. That's all TA should ever really be used for. It has no, like, there's no statistical proof that TA has any ability to forecast anything ever. So all you can really use it for is to define risk and train yourself not to fall for the observational bias, which is harder, probably. Girk's book will be My Life Among the Apes, where he discusses how chat kept repeating terms they heard but never really understood. No, it's easy. You can tell it's a double top because 75 people underwater on their puts post double top on Twitter/X. Yeah, that's another way of being able to define the beginning of a bigger bull run when bears are their saddest. Can you talk at all about volume over time? Like when comparing high volume, low volume moves, would you be looking at just comparing the volume to the last swing or long-term average volume? In swing trading, you generally want to look at longer term volume trends over time because you're looking at like that like accumulation and distribution periods of positioning. And so it can benefit to understand when the volume trend has substantially changed. But if you're just day trading, there's no reason to look back further. You can just look within the same time period. Stop loss limit changes with how confident you are in your TA. There's a lot of factors. It's not just confidence in your TA. Your ability to do TAs, it's going to be, even if you draw the most accurate TA ever, you're only going to get a couple percentage points a higher win rate, right? But understanding other dynamics of your position, like liquidity in your contract, some days you've got a lot of like sell side pressure. You might have to set wider stops. So like say you buy the 5160 put right now, but bulls are selling that put. So bulls are selling the put that you're long on. You're gonna need to adjust your stops relative to how much sell pressure there is on the position you're long on, right? Because your bid ask on this position is going to be far more volatile than if you'd picked a put where there's less sell side interest. And this can go for calls too. A lot of the times, you guys have probably been in a call that's still out of the money, but up, right? So, say you bought the 5170 here, right? You're still up a little bit, but you're out of the money. And so, you've run into a situation where bears and other bulls are probably selling the contract that you have, right? And when they start selling that contract, you might get a larger spike, like the premium might drop more on the test of the resistance that you have the call at, because everyone piles in to sell it, right? You get bulls taking profit on it, and then you get bears, selling the call. And so you might end up in a situation where you get like, your premium goes up, but then you get a big drop in premium, and this will trigger a lot of people's stops as they approach resistance. And then premium will kind of gap up and trade at the range that the contract's trading at, right? And to avoid this, your best bet is to either take profit on the test, right? Or pull your stop back on the test of the resistance. So, say your stop's back here, pull it back as you approach resistance. That way you don't get stopped out on the bigger move in the bid ask. And then once things stabilize, you can move your stop back up again and kind of define your risk. If an ascending triangle breaks down, such as what seems to be happening now, is that more bearish than normal? How should volume back that up? If it breaks down with a lot of volume, that's more bearish than normal. Otherwise, it kind of just turns into distribution, like bearish distribution. This looks like momentum is flattening out. Some slight downs soon. I still think we're about, I don't know, we're probably about 10 minutes from a bigger breakdown. 5 to 10 minutes from like a breakdown back to like maybe like the 160 level. But I would say like here is where I'd be targeting. Thanks for bringing it down. I never thought much of TA, but that makes better sense of the numbers. We don't go down. I know, Popcorn. Stops profits. What is this you speak of? Yeah, no problem, Mouse Cup. Calls get cheaper. Yeah, they do. But it doesn't always work out that way, right? Sometimes the pressure is too great and you get a failure, which I think we're going to get, here in a minute. Look at me predicting the future. No, defining risk. Yeah, the breakdown part's not based on TA. That's something else. But anyway, yeah, sure. That depends. So we could get a continuation of the breakdown here. And then that becomes very bullish because bearish momentum is going to increase, right? It's going to pick up. Or we can find stability here. So this part is very important. So we got the breakdown, right? This is the capitulation. The delta had become weak enough, right? That it's no longer supportive in a sense. But that all that delta can just be bought back. Now, if not enough delta is bought back, then it can continue to fail, and then bearish momentum would increase. It's a very simplistic way of looking at it, but no, it's bearish. Bearish if we keep breaking down. Bullish if we reverse. I meant to type I never thought much into TA. Like, I took things at face value. If these signs show up, there's a chance it could do this or not. That's the market. But it changes the way you view things if you just look at signs as staking probability indicators, not actual signs. Yes, it does. Stacking. Oh, okay. I mean, they are, right? Like, every TA formation has some sort of probability behind it of what could happen next. Some are higher probability, some are lower. And that's part of the, but none of them are guaranteed, right? And since most of them fall around the 50% level, your best bet for using TA is just as a risk management tool and not to use it as an indicator of a probabilistic outcome. There's far better data to use for probabilities. This is a masterclass. Can we do this every day? No. Like the weird plots with every simulated outcome that Dork loves drawing? Are you talking about Monte Carlos? Sure. Does VWAP come into play at all when factoring the MM sell-off? Yes and no. The MM's neutral point is not necessarily VWAP. Can you clip the entire stream? That'd be hard to do. I could probably clip a bunch of shit, though. Give me a second.